Good afternoon, everyone. I'm Hamid, CEO of Blanc Labs. We are a full-service technology consultancy firm, really with deep domain expertise in banking and lending. I'm very excited today because we have an amazing panel with deep expertise in lending, and we're going to talk about lending opportunity, market dynamics, and growth opportunity, obviously. Before we get started, when we look at lending market today, and especially mortgage market today, obviously see high interest rate. We also see some record high amortization periods. Homeowner needs have changed. We have some significant number of actually newcomers to Canada who want to buy their first home. And we have a bit of a housing affordability issue. So there's mounting pressures on lenders on the mortgage market. At the same time, there are exciting opportunities. So hopefully today we explore the market dynamics and opportunities, so you leave this panel with some insight that help your business decisions. So with that, let me start with a quick intro of the panelists and some questions for a broader conversation. I'll start with Ashley, Vice President of Lending, Residential Lending and Equitable. Blake, Vice President of Capital Markets at Nesto, and Hayden, CEO and founder of Fraction. So Ashley, today we had a conversation with Andrew, really nice keynote. He walked us through an amazing journey Equitable had in terms of its growth from a shareholder perspective in the past 10 years or so. Equitable has delivered the highest shareholders, but at the same time, incredible customer experience and customer service. So tell us what differentiated Equitable. And Equitable is obviously, as Andrew mentioned this morning, is Canada's 7th largest Schedule I bank, essentially. So as the VP of Residential Lending for Canada's 7th largest banks, what differentiated you from the Big Six and the rest of the market to provide such an amazing growth journey?
Yeah, thank you. And Equitable is part of the alternative lending community outside, which we defined as outside of the Big Six banks. That plays in the regulated space. We're still regulated by OSFI or others, competitors in the industry, but we're not in the private lending market, where you might hear about mortgage investment corporations. And in reality, why that area has grown so large in Canada has been in partnership with the mortgage broker community. Mortgage brokers as a share of lending in Canada has increased from 21% in 2006, and now it represents almost 1 in every 2 mortgages in Canada. And as part of that, there's a huge space where lenders have stepped in an innovative way because they don't have the same name recognition as the large Big Six players, where they target some markets that maybe don't get as much love as a typical salary borrower who walks in the door. Some of those include business for self. You own your own business, your financial statements, but maybe your income's, it fluctuates. New immigrants to Canada is another marketplace where people traditionally have had challenges accessing credit. That's one where the alternative players have really played a large role, and those with bruised credit. So that's how we think about the space. We actually don't think it's a riskier space. We think the risk is more perceived in nature. We find those borrowers sets I've just mentioned are actually very resilient over time. To run your own business, you have to know what you're doing and have access and means to capital. And so we feel that's really where the value has been played by people outside of the historical Big Six institutions.
Okay. Thank you, Ashley. Blake is VP of Capital Markets at Nesto. Blake, you've helped Nesto transition to mortgage lending. Nesto was recognized by CLA as recognized with the award of the Best Lender of the Year. So what type of innovation you brought into the lending space and mortgage market? What set you apart from the rest of the industry?
Sure, yeah. Nesto is a startup still. I think we're roughly 5-6 years old now, and our focus is 100% mortgages. And our goal was to innovate the entire mortgage market. And the way we did that, we're not introducing any one product that's specifically innovative to the market. We saw thousands and thousands of innovations that had to be made in the mortgage process to make the process easier for clients. And to do that, to innovate 1,000 different times, I think what you need to do is you have to have the best employees and the best staff with experience to lead in technology, process, capital markets, and every other aspect of the mortgage. And the way we did that is having a very clear mission. So we feel that home ownership is one of the highest impact actions that a person will take in their life. You know, it's the process of choosing your home. That's where you're raising your family. That's where you're getting stability and ingraining yourself in a community. And for most people, myself included, when you get that first home, the mortgage is more of a barrier to entry as opposed to an enabler in the home buying process. So with that mission to improve the overall mortgage experience, we were able to attract top talent that saw the same problem and saw the opportunity. They were engaged. They come to work every day looking to solve one of those 1,000 problems that are in the mortgage space. And I can say from my own personal experience, you know, when I've worked in mortgages and capital markets for over a decade. When I went to go get my first mortgage, I had no idea where to start. I had probably 10 to 20 different issues that came up with the lender, including the lender, a small process that they overlooked. When my contact left the organization, there was no backup. Nobody was there to replace them, and my purchase almost went under. I almost lost a lot of money because they had that one misstep in the whole the mortgage process along the way. So when I joined Nesto, you know, I brought that up. Every employee, I think, that's joined Nesto has brought up 2 or 3 challenges they see in the mortgage space. The technology team, the process team were passionate about it, and it didn't make Nesto any more money to solve that one risk that's in the mortgage process, but it did ensure that that's not going to happen to any of our clients, and it takes a little bit of risk away from any individual who's looking to get a mortgage to purchase a home. So that's kind of been the evolution of Nesto and how we've been able to innovate by fixing all these minor problems along the way. And then, you know, along our path, our business fits our mission, and our mission is to improve the mortgage client experience for every Canadian. And so we started off as a broker because that was the easiest point of entry. But then we found that the lenders we're handing those clients off to would sometimes fumble or make a mistake. So we quickly decided we're going to enter the lender space, improve that. After that, as a lender, once you funded the mortgage, you have to hand it off to a servicer. We originally outsourced that, but then we recently took that over, seeing there's more improvements to be made in that space. And then eventually we looked at our mission and said, you know, we're not really, we're trying to improve the mortgage experience for everyone, not just Nesto clients. So last year we moved into the SaaS and the white label business, so we're helping other lenders as well improve their process and their mortgage experience.
Thank you, Blake. Hayden is the CEO, founder of Fraction. Fraction is kind of like mortgage without monthly payment, or maybe a kind of a reverse mortgage without monthly payment, so quite innovative. Hayden, what is the type of innovation you bring to the Canadians, or what sets you apart from the rest of lending community?
Yeah, so we're a little bit unique in that we're not a regulated institution like EQ is, but we're also not a MIC. So we're backed by institutional lenders, mostly out of Europe. We introduced essentially what is a reverse mortgage with no age restrictions. And so we have a fixed rate term, and so borrowers use us mostly to reduce their DTI or the cash flow that they're putting out every month. And that can be used for what I call like offensive reasons. So people who want to access their home equity to put it into the market, or people that might have come into like a tough time and need to take a break on their monthly payments. I think from an innovative perspective, we think about it both from a product perspective as well as a technology and process perspective. So on the product side, it's really looking at areas where we can bring institutional grade capital in that can access some of the areas that the regulated institutions don't want to touch or can't touch, and where the mix are just a bit too expensive. And so a good example of that what we're doing now, it might be long-term fixed rate mortgages, it might be things in the IO space, it might be things like home equity investments, which are in the US. And so these are all things that we're looking at from like an innovative product perspective. And I guess the other thing would be around prepayment penalties as well, which are also not allowed in the US. And so I guess for context, we operate both in Canada and we're operating in the US, so we have a bit of cross-border experience. And then on the technology side, very much like what Blake was talking about, we look to do things externally and partner with external companies, and we just found that those processes weren't really great, and so we ended up building our own loan management system as well as our own loan origination system in-house. So we do everything from origination to servicing, as well as portfolio management and portfolio monitoring. And so at the end of the day, what we're really looking to do is give Canadians alternative options that they haven't seen before, as well as provide a first-class experience for them. And I don't think you can do that without kind of owning that yourself. And so that's really what we do at Fraction and how we're a bit unique. Yeah.
Okay. Thank you so much, Hayden. So now let's move a little bit and talk about, emerging technology and the role in innovation in the mortgage space, especially recent advancement in AI and generative AI. There are like different perspectives of whether or not they could add value or could add business value. For a bit of context, I'll quote some research study as well as things we've done ourselves at Blanc Labs. So a research study by McKinsey and Company was actually fairly recent, late August, about 2 months ago, suggests that using generative AI, you could boost your top line revenue somewhere between 2.8% to 4.7%. That could be close to 5% increase in top line revenue. Specifically, these numbers are for banking and lending sector. There's another study by BCG that suggests with personalizing customer interaction, with using AI, you could potentially double your cross-selling rate, add about 4% to the profitability margin, about 4 to 5 times better lead conversion, and reduce customer churn rate somewhere between 10 to 30%. When we look at a lot of use cases in lending and banking sector, we see a lot of heavy usage in customer operation. That's things like chatbot, contact center, and customer support. We've seen a lot of use cases in sales. You have maybe cross-sell, customer retention, renewal, and so forth. As well, less significant number of use cases, especially in generative AI, using large language models in risk and legal, because LLMs can really help understand complex documents and reduce risk there, obviously. And in software engineering, we've seen a lot of usage that reduce the cost of software engineering and essentially not only lower the cost, but accelerate time to market for new product development. Now, that's broader context of the industry and use cases we've seen, but every lender is unique, and I'm pretty sure you have your own strategy. Each of you will have your own strategy in terms of what works for you. So what I'm going to pose to the panel is their perspective about whether or not they see some form of a business value in adopting emerging tech, such as AI and generative AI. This time, Hayden, let's start from you, your perspective about AI, Gen AI, and emerging tech, generally speaking, in terms of the business value.
Yes. So I think generally, if you look at other industries that are, I guess I'll call it like not as heavy on risk or focus on risk, you're seeing a lot of Gen AI being put out as essentially a co-pilot. So if you think about a borrower working with you, they could potentially have a mortgage co-pilot that walks them through the process. They can ask a question anytime in real time and get answers, whether that's the state of their application, questions about how a mortgage works, questions about how documents are constructed. And so I think there's a big opportunity there. And then from a business perspective, obviously that reduces your OpEx cost, which then you can pass along to the consumer at the end of the day. From a risk perspective, I don't think that LLMs are the best models. They really are good when there's not as such hard lines put in place. I think there's better technologies, better structures for those. I think AI is a really big term, and Gen AI is kind of the hot thing right now. But within AI, there's a lot of different things. So at the end of the day, I think if you can reduce OpEx, provide an experience to the customer where they can ask normal questions and get normal answers back rather than having to wait, that's a really big opportunity. But I'll let the panel add anything more.
So Blake, you're fairly, I would say, technology-first company, right? That's what Nestle is. What's your perspective of emerging tech, including AI, data, and generative AI on lending?
Yeah, and Nesto's advantage in our innovation is really in our tech and our processes. So with AI, we test every option that we can find, and we're heavily invested in it. But I think we see the kind of the same challenges as Hayden mentioned. whenever we test anything, we test it for efficiency, accuracy, and then strategic vision if it fits in with the organization. And we found that a lot of these AI programs don't actually work in lending. For the reason you mentioned on underwriting, the accuracy isn't 100%. It's often closer to 90, and that's great for the 90%, but that 10% is pretty important. For client interaction as well, it's a huge investment buying a home or a purchase. And if you have one comment that seems out of place or they can tell it's AI, you lose a lot of trust with that client. So we don't really use as much for that. There's some scripting and there's some, when we can make it clear that it's AI, we're good with that. But there are a lot of small processes where AI is fantastic that we have used that technology. Fraud detection is a big one. In capital markets, we obviously hedge the interest rate behind the mortgage rates that we're offering. And what we found is that AI does a fantastic job of predicting the funding probabilities, funding timelines. And for my personal business of hedging that portfolio, it could be an increment of like an incremental 10% profit that we see on risk management and locking in favorable interest rates. So like when your stat in terms of how much you can actually increase profit, we see a huge value.
And actually, Andrew Moore mentioned this morning that Equitable has a very unique perspective to technology and innovation. And the industry, generally speaking, knows Equitable as an innovative bank. What's your perspective? Have we done anything?
Yeah.
What do you think about it?
Yeah, thank you. It's good to be called an innovative bank. They don't always go in the same sentence, so it's positive. But I think we look at it a couple different ways. Part of it is partnerships. Andrew talked a bit about that today. For us, it's about making sure we have the right partners to complement what we build internally. So some of the ones we had on the sheet today, we have Fundmore, a very key partner. We have some technologies with them already. We're about to launch imminently a new underwriting system with them, which will really help add to our capabilities and future partnerships and use of AI. We also partner with Flinks on bank statement share tools. So that's really helped improve our broker experiences, improve our customer experiences across the board. Some technologies we want to develop in-house. So for instance, we've developed a digital document reader, which is able to read certain types of income verification documents, specifically bank statements, really speeding up that process. And thinking about AI for us is what's the problem we're trying to solve, and then try to solve it with a specific technology, and then how do we add to that? It's not just about turning off the lights and everything goes through the supercomputer. And then another one is use of Gen AI, which I'm starting to learn about more and more myself. I don't come from a tech background, but just how we can use that to help proceduralize or provide some of our team members with procedural answers very quickly in a more robust format. And we're excited to launch that internally in a few weeks as well.
Okay, fantastic. Thank you so much. In the previous panel, Dominic mentioned, the importance of data, access to data. Also, data as essentially like enabler of innovation, right? And when we talk about AI and Gen AI, really come back to what type of data strategy a company has. So does anyone in the panel, I want to make an open conversation in case someone wants to jump in, has a perspective of access to data and data strategy? If yes, are there steps you have taken? If no, are there blockers? Any perspective on data, both internally in terms of if you have data lakes, I know Equitable has one or not, and also externally, and that was what Dominic was talking about, because Customer 360 is obviously leverage internal data, but you could also have Customer 720 leverage external data. So any perspective on the data and access to data to unlock even more innovation and unlock even more value?
I'm happy if that works. I think we also have a data lake. When we built our servicing platform, I think for the mortgages, essentially the process is just managing data, and then the user interface is added. I mean, that's my perspective. You're collecting the documents, the client information, and then you're making a decision, and then managing the going forward. One thing we didn't mention on AI with data is obviously security, and making sure we're keeping that internal and manage and nothing like the biggest thing that can go wrong quickly is if you lose control of that data. So I think that's core to any business as well. But I think any mortgage company, data has to be the focus. You need data lakes. You need to have a system that's built to be able to create products quickly using the data you have and making sure it's very reliable.
I think from our perspective, more access and openness and consumer ability to share their data with certain partners would go a long way. We've heard a lot about open banking today. I'm sure we know a lot about the challenges there for a bank like Equitable. That'd be very important for us to help see some innovation there. It would help us improve customer experiences. If we're able to get income verification directly, we can take out fraudulent components away from that versus the way it's shared today. That's really important. We build a lot of credit models internally that we rely upon. Having more access to different consumer data would help us improve upon those. And then as we think about our existing portfolios as well, we think a lot about our customer retention and just what our clients are feeling. Because typically, for an Equitable client, the mortgage is the only product we have. We're not an incumbent with the bank account information or others. So for us, the more ability that a consumer has to control and share their data, the more the consumer benefits from that, and the more a lender such as ours, but also the entire fintech ecosystem will benefit from that.
Yeah, I think we think about it kind of in two different ways. One is on the origination context in terms of what's the data that you want access to so that you can reduce the user input and make that experience really great. So a good example of like what's not very accessible in Canada but accessible in the US is payroll data. So there's a company called Pinwheel as an example that integrates with companies like ADP where you can actually grab income through an API automatically and not have to upload income documents. And that obviously makes it a lot easier both for us and for the consumer, but also accuracy. And so from an underwriting perspective, it makes it much more accurate. I think one area that we see in Canada that's really tough as well, especially being an equity-based lender, is MLS data in terms of sales data and the accessibility and the ability to get AVMs correct compared to the US. We see wild fluctuations in the AVMs, and it makes it really tough from a portfolio monitoring perspective. And so that's another thing that I'd really like to see done better is the MLSs give up that data in a much more robust way so that we can do better underwriting and do better risk control. And so those are the main things that we think about at the end of the day.
Okay. Let's also talk a little bit about brokers. Brokers and broker channels are a very important part of the lending ecosystem today. With the advancement of technology, digitization, and automation, there's a question mark about how the role may evolve in the future in terms of serving the customers. So what is your perspective about the role of brokers in general, and whether or not do you think that role evolve over time?
Brokers are Equitable's lifeblood. We've always been a broker business. It's how we've set up our systems and processes. We've been very successful based on it. I think the future of brokers is still very bright, whether it's a digital online broker such as Nesto, whom we partner with, and we're not one of the ones that screwed up your files in the past either. Just want to be clear on that. We're one of the better lenders. Or if it's one where people, when you're buying a house, for a lot of people, they want to talk to somebody. I don't think that's going to change. And I think what brokers have that maybe some other incumbents don't is a nimbleness. They're not tied into legacy ecosystems. They're able to use and adopt online technologies. For us, a big advance in our own broker experience was being able to share and submit documents digitally in a secure fashion. We've done this with an online platform for the last 2 years. So we think, if anything, the broker market, which has more than doubled in size in the last 15 years, we think it's going to continue to increase and take up a broader share, just as consumers want more choice, they want more options, and they want the best deal possible, whatever that may be.
So in a way, you've seen that, you see the value is going to be there, even grow over time, and you see the technology as an enabler of this channel, essentially.
Definitely an
Empower
enabler.
them further.
Yeah, definitely an enabler, and I think there's a lot of innovators with great ideas to market, and I think the broker channel is much more likely to adopt them, even on a trial basis, than maybe moving an entire cruise ship or an entire bank in that direction.
So you made a prediction about brokers. Back to what Gary said. What's the prediction of the future of the market? Because at the same time, mortgage market, generally speaking, not just brokers, in the sense that some people have concern about risk, mortgage risk downstream. Do you have any perspective about that as well, in terms of the risks in the mortgage market?
Yeah, like there's risk in the mortgage market today, just like any market, and through the cycle. I think how we're thinking about it as our own institution and book is we're very fundamental based. Our products and just the rigor that we put into our loans, there's income components to it, there's a collateral component. We've taken a very rigorous approach over time that has served us well. You hear a lot in the media about 70-year amortization mortgages or very long mortgages. Those aren't obviously products. Those are a function of a specific variable rate mortgage product that some people have. Whether or not that's inherently riskier is difficult to say because people are only contractually obligated to pay the payment that's there. So if the mortgage is gone out longer than that, they may or may not have trouble with that down the line. I think on the whole, yeah, people are going to have to really deal with a challenging market and increasing the amount of payments they allocate to mortgages. Within the way we see it in our book has been very resilient over time. And while we are seeing some additional stresses, like we think by and large the fundamentals of the real estate market and the way that we lend are still very strong for the long term.
I think generally over the next few years, the broker market, especially where most of our focus on, is going to really shift to the alternative space, where for the last few years it really was focused on prime lending, just given what was going on with rates. And I think for end users, having someone, the complexity of these products as you go down the curve of the credit curve become exponentially more complex. And so having someone who can explain those products to people in person and give them that time is really important. So I think over the next few years, brokers are going to play actually a more important role, very much like you were saying, as payments increase, people are going to be looking for alternative products, whether that's IO products or things that reduce cash flow, to be able to keep affording their lifestyle.
I mean, from Nesto's perspective, we were a broker, online digital broker, and we were seen as a disruptor to the broker space, I think, originally, and there was some conflict there, but ultimately, in my mind, and I guess I was brought in to bring us from a broker to a lender, but I will say that EQ is still going strong, and I haven't, we only have good things to say about EQ Bank as a lender, but as a challenger
give us one bad thing.
Yeah. As a challenger to the broker space, we look at mortgages. There's the sales and the contact point with the client. There's the underwriting processing. Then there's the servicing and all the other processes. That first point of contact with the client is all about trust and adding value with good advice. I think as long as the broker, that's the value they're bringing, they'll stay relevant, and then they just need to improve their, keep evolving as the industry evolves. And I think we'll see two segments: the easy mortgages, where it's all about efficiency and low commission, which I think where Nesto came in that space. But we're only digital. Brokers are often like word of mouth and in the community. And then there'll be the more challenging loans as well, where the brokers have an advantage. If something's going wrong, you might want somebody to meet in person or at the property and have that conversation. So I think that space is still going to be there as long as people need to talk to somebody about their mortgage.
Okay.
Yeah, I think it's worth noting that it's actually pretty simple to fully automate a mortgage process. It actually turns out that depending on who your client is, they have a very different expectation of the track that they want to be on. And so one thing that we had to do was build a lot of off-ramps for people who want to ask questions, who want to get out of an automated process and feel like things are actually moving too quickly.
Okay.
So
Fantastic.
Agreed.
So we have like maybe 10 seconds to conclude. So thank you, everyone. In terms of lesson learned and conversation we had, obviously each of the panelists have a fairly distinct approach to mortgage. So there are ways to be innovative and to be different, obviously. On emerging tech, Gen AI and AI, I quoted some study. I finished it up with another study from BCG that says for each $10 billion asset under management, there's a potential profitability of another $10 million. For each 10 billion asset under management, profit of $3 million, $30 million per year. Obviously, on brokers and broadly speaking, human touch, I think the panel concluded that technology will empower them and will enable them for the foreseeable future to play a role. And you see the mortgage market, generally speaking, as a healthy market in Canada. So thank you, everyone, for joining us for this conversation.